Should we start? A very good evening to all of you and a very warm welcome to our Q4 and fiscal 19 results announcement. Today I have our CFO Pratik Agarwal, our CHRO Appa Rao, and Anand Birje, who heads our global digital business. I'm happy to share that this year HCLites have once again delivered an industry-leading performance. It's really a blockbuster performance for the fiscal FY'19. I'll start with the quarter and I'll give you a color on the full year. The quarter that went by, we posted a strong set of numbers with a constant currency growth of 3.3% quarter on quarter. And this is following a 5.6% QOQ growth in Q3. We delivered an EBIT performance of 18.9% this quarter. The most significant aspect of last quarter is we hit a booking peak again. It was the highest booking we did ever happen in the last quarter. And if you've been following our commentary on booking, this will be the third time in this year where we've hit a booking peak. We also had a very strong growth in our next generation services, which is our digital and cloud and Internet of Things and cybersecurity. We grew 28.7% year on year. This solid performance is a strong testimony to a brilliant execution in our chosen market segments. If you want to look at the full year performance, our revenues grew 11.8% in constant currency, which is higher than the top end of the guidance that we gave in the beginning of the year. Of course, 11.8% is in constant currency. We met our EBIT margin guidance for the fiscal, closing the year at 19.5%, which is within our guided range. In rupee terms, our revenues grew 19.5% year on year, and our EBIT grew 18.3% year on year. The combined share of Mode 2 and Mode 3 revenues stands at 28.3% for fiscal 19, growing from 23.4% in fiscal 18. We signed 78 transformational deals in FY'19. In Q4 itself, we signed 17 deals. We've also witnessed very strong client additions, and our large customer base, which is greater than $100 million customers, continue to increase. We added 2 more customers to our $100 million category. Giving us a little more color on the service lines, verticals, and geographies, our infrastructure business has posted a stellar result. We've grown 11.1% year on year for this fiscal. This quarter it grew 7.3%, and this is on the back of a 10.4% growth in the previous quarter. So infrastructure business is witnessing a strong momentum. Our engineering and R&D services grew a solid 19.5% year on year on constant currency basis. Our business services, which is now called digital process operations, posted a solid 51.5% year on year. This is well supported by a significant transformation that we've done in our digital process operations service by bringing in RPA, AI, and machine learning-led automation, which is what is helping us deliver good growth in our digital business process operations. Our application business grew 3.5% year on year. However, this quarter, our application business posted a greater than 5% quarter-on-quarter growth, which is one of the highest growths on a quarterly perspective. Overall, application business is a little soft from a year-on-year perspective due to compared to the other business lines. This is attributed to a couple of clients in financial services in Europe, as we had mentioned earlier. In terms of verticals, technology and services vertical grew 30.7%, and life sciences and healthcare grew 22.7%. These are the 2 top performing verticals. In terms of geographies, Americas, Europe, and rest of the world, all of them delivered a double-digit growth. And ROW, excluding India, also delivered a double-digit growth. As I mentioned earlier, our Mode 2 services delivered a strong 28.7% year-on-year constant currency growth. It's really backed by our investments in building capabilities and competencies in a plethora of next generation skills, investing in labs, investing in the partner ecosystem to drive the right outcomes for our clients. All of this has helped us grow 28.7%, and our engagement with our clients in the digital space is quite different from what the traditional players are engaged in. We are working in a lot of engagements with an outcome-based solution, and we're also focused on delivering an integrated stack with digital as a top-up from the overall solution perspective. And we will continue to invest in the new generation services in FY'20 as well. Our Mode 3 business grew 48.4%, driven by production platforms in constant currency terms. And I'm happy to share we've launched a whole set of new products, which is all our own IP. And this is going to strengthen our overall portfolio in terms of products and platform. As we enter into FY'20, I believe FY'20 will be a good year for us. It's a good year it is going to be a good year for the industry as well. The demand for technology services and products is definitely very high. It's very clear that every industry is getting reimagined with a lot of technology solutions to deliver or reimagine their businesses. So that's going to create a tailwind for the technology services as we go into FY'20. And all the investments and capabilities that we have built, which has helped propel the growth in FY'19, will continue to do so in FY'20. In infrastructure business, which is really the digital foundation of an enterprise, we see growth coming from two key areas. First is there is a reality which is sinking in that it's very important for all large enterprises to adopt hybrid cloud. And this will, while you continue to consume public cloud, you will also need to build software-defined stacks within your enterprise. So hybrid cloud is the right strategy, and there is a significant mind share around hybrid cloud strategy, and we are very, very strongly positioned to encash on that opportunity. The second big theme is around digital workplace, which is driving from servicing devices to users to experience. And our offerings are highly differentiated. We are the only player who's on the top quadrant in all the analyst reports, and we have a very strong mind share in the digital workplace services. In terms of industry segments, what we're interestingly seeing is some of the traditional laggards like manufacturing, both discrete and process manufacturing industries, thanks to technologies like 5G and Internet of Things, are investing significantly to see how they can leverage these new technologies to modernize their business or create a multiplier effect on their revenues and customer experience and their market penetration. So we see these segments doing very well, and that's going to also help HCL grow. And overall digital transformation spend, if you look at the overall industry, IT services spend is about $6 trillion, and about 20% of that is in the digital space, and that's growing at 18% year on year. It is forecasted to grow at 18% year on year. And our Mode 2 services are well equipped to kind of leverage this big opportunity that is in front of us. In FY'20, we aspire to have our combined Mode 2 and Mode 3 revenues to be about 35% of our total revenue. And this is exactly what we committed 3 years back, that in 4 years we want to get to 35%. The mix of Mode 2 and Mode 3 should be 35%. Looking ahead into FY'20, we are guiding our revenues to grow in the range of 14 to 16% in constant currency, and our operating margin to be between 18.5% and 19.5%. Team HCL has high aspirations. We aspire to reach $10 billion milestone this year. It'll be a great milestone for HCLites to look for and be very, very proud about. Overall, we see a strong trajectory for the company. We have created a good momentum. We've established industry-leading growth, not just this year, but for the last 3 years. We've been the top of the charts in terms of growth performance. We do believe this trend will continue due to the best services that we deliver and a highly differentiated business model, which is insulated to some of the economic vagaries. I think it's overall, we're in a very good spot. We are very confident of the momentum in the market, our ability to harness the momentum. With that overall commentary, I will hand it over to Prateek to provide a little more financial analysis.
Thank you, CVK. Good evening, all of you. I'll just give some more additional color on FY'19 results. As CVK already mentioned, we delivered 11.8% on the top line beyond the guided range. We had re-emphasized and sort of guided towards the higher end of the range in the last 2 quarters. and we are very pleased to come out at 11.8 beyond that range. We also exceeded the ingrained within that the organic growth, which we had given a range of 4.25 to 6.25. We are very pleased to have exceeded the higher end of that range as well. So it was a great achievement both on the total as well as on the organic growth. We maintained EBIT at 19.5%, which was again within the range. We are delighted to announce in rupee terms, our top line crossed 60,000 crores. Our EBITDA was at about 14,000 crores. And the most pleased to announce the profit after tax, the net income amount of 10,000 plus crores. So those are very healthy numbers, very healthy milestones to cross, and I'm very pleased to share those numbers with you. During the year, we paid out 52.6% of the profit after tax of the net income as dividends and buybacks. The earning per share for the company for fiscal 19 came out to be 73.6, which is a very healthy 17.5% growth. The 19.5% was on the top line. The EPS also grew 17.5%. And we've also started publishing what I call the cash EPS, which adjusts the EPS for the amortization expense and the MAT, the minimum alternate tax adjustment. That number is actually at 84.9, which is the cash EPS, and that grew 15.2% year on year. So very healthy numbers there. During the year, we also announced the acquisition of 7 products from IBM. That is something we expect to close hopefully by the end of this month. Worst case, I guess it could slip to the month of June, but that is what our expectation is, and that is what is factored into the 14 to 16% growth guidance that we have given for the next year. That 14 to 16% comprises again 2 parts. 7 to 9% is the organic growth guidance that we have given, much higher than what we gave for last year and what we achieved last year. So 7 to 9% organic growth. The balance 7% is really the mostly coming from the acquisition that I just spoke about, which is the IBM 7 products, as well as the flow-through impact of some of the acquisitions we did last year, which were not counted for the full year last year. We also closed Strongbridge Envision. That deal closed on 1st of April, so that will also give us the benefit, which is all included in the 7% that I talked about. On the margin side, our guidance is 18.5 to 19.5. We came in at 19.5 last year. The last quarter of the year was at 18.9. So that is all factored into the new guidance, 18.5 to 19.5. And we continue to invest in our Mode 2 businesses, especially because over the last 3 years we have invested. We are seeing the fruit of that, and we believe it is the right time to keep investing where this can generate disproportionate returns for us. So with that, I'll hand over to Anand.
Thank you, Prateek. I don't know if this is audible. Thanks, Prateek. As CVK said, this has been a really fantastic year for our Mode 2 services business. And we've been talking about it for the last 2 years that we saw this inflection coming, and that's where we were investing, building out the capabilities. Just to remind all of you, our Mode 2 services include our digital and analytics services, which includes our experience design, modern applications, and analytics and data. It also includes our cloud native and cloud transformation services. It includes our IoT capabilities, and it includes our cybersecurity services. These are the services where, as CVK said earlier, enterprises are significantly changing their IT spend to digital spend. And the spend is moving to these set of capabilities and services that they are trying to build within themselves. And we're seeing this across the enterprise vertical. So traditionally, in the first few years, we only saw consumer-facing enterprises, that is, retail, CPG, banking, retail banking kind of customers, transforming digitally faster. In the last 2 years, we've actually started to see B2B and B2B2C enterprises, so manufacturing, utilities, oil and gas, actually start looking at digital transformation, not just for consumer engagement, but also for operational effectiveness and efficiencies. And so we're seeing more and more full stack set of digital transformation services that include applications transformation, the underlying foundations of infrastructure and cloud, and then, of course, business process services transformation. So we're seeing a lot of that in the last 1 year. So it was a fantastic growth year, 28% growth overall from the year that went by, but I think the last quarter was 14% growth, again, on a high growth quarter behind that. We actually expect this momentum to go on, and so we continue to invest in building capabilities, bringing in leadership, retraining of talent, and of course, ecosystem of new partners that we constantly create. Apart from that, Prateek mentioned the acquisition that we recently did. Most of this growth so far has come organically, and we only will look at acquisitions for capabilities or point sort of strengths that we want to add to our capabilities. So StrongBridge Envision was an acquisition we did in the US, a company that brings strong capabilities around digital strategy, organizational change management, and really digital program management, things that are really, really critical in execution of large-scale digital programs. So we'll continue to build organically. We see the momentum across the verticals. We actually think that digital transformation is becoming mainstream and only starting off in its real avatar, and we're kind of well geared to participate in that market. With this, I'll give this over to Appa Rao to cover the HR transformation at HCL.
Thanks, Anand. Good afternoon to everyone. You heard the growth story of HCL. So if the growth story has to be intact, obviously the people story has to be intact. So a bit of metrics on the people part. This quarter, we had a gross hiring of 14,249 people with a net hiring of 5,637. And overall, if I look at the financial year, we hired 51,000 people with a net hiring of 17,884. So while the hiring arm is working reasonably well, the training arm is the one which actually will help us in our skill set scale at an affordable price. So we have dramatically improved our training hours. I mean, last quarter, we were doing around 30,000 training hours, 30,000 people training. This quarter in digital skills alone, we have trained 84,900 people, which is an all-time high. We spent in this financial year 3.02 million hours in training our people. So while getting talent, good talent from outside is important, at the same time, reskilling, upskilling our talent is equally important for us because we are aspiring for a 30 to 40% growth over last year. So the training engine is like a factory now. We have got some scientific methodology. Hiring, we have automated the entire hiring cycle. So there is no manual intervention there. The completely end-to-end, right from CV matching to offer release, everything is automated. So that is one good aspect in our thing. At the same time, we also have to retain people. So our attrition is slightly lower compared to the last quarter. It is at 17.67%, 13 basis points lesser than last quarter. We continue to focus more here in terms of even reducing this quite a bit. We have some indicators, but I'll leave it to the next quarters. And our focus on having a workplace which is equally gender diverse is very, very high. It comes right from the board and the senior management. And I'm very glad to let you know that we have increased our gender diversity by 120 basis points from 23.7% to 24.9%. And this is across all levels of the employees, all bands, across all bands. The senior management has grown from 2.8% to 5.4%, almost doubled. So there is tremendous amount of training, upskilling our women leaders so that they can occupy the higher echelons of the organization. And we continue to have our localization wherever we are there. Today we are in 46 countries. Our localization is 67%. We are not dependent on any visas overly. We do apply a few cases, but we are more important. We want to diversify our skill base across different geographies. And we are in the process of finalizing the increments. Our cycle is from July to June. So in the next couple of weeks, probably we will do that, and we will be industry competitive. So these are broadly the metrics and the commentary on HR. Thank you.
Yeah. Thank you, Appa.
Back to Sivik.
We are happy to take a few questions from the audience here.
Or on the call.
Start here.
Hi, I'm Varun Sood from Minsa. Two quick questions, please. Firstly, what was the organic growth for this year?
So overall was 11.8%. Organic growth was higher than the highest end of our guidance. We had said it's 4.25 to 6.5. Our organic growth was higher than that.
So how much was it? Can you just let me know?
Between 6.3 to 6.5. So.
Okay, thank you. So the second is that it was a record bookings, like you said, third consecutive straight quarter. But if I look into your Mode 3 strategy, much of the growth is coming from acquisition-led or IP-led, which broadly comes under the Mode 3. So how do I really reconcile when you are saying that there has been record bookings because your traditional Mode 1 business continues to grow about 4.5 year over year? Much of your growth is just from Mode 3. And even in FY'20, you've said much of the growth will, again, not much, but significant growth will be about 7% would be from acquisitions. So how do you reconcile the two, sir?
Yeah, so basically, if you look at our breakdown, our 14 to 16, 7% is inorganic, 7 to 9% is the organic growth, and 7 to 9% is significantly higher than the growth that we delivered last year. And this all comes grounds up based on the planning, some deals that we have signed during the year that has helped us deliver a better outcome than even the guided range, right? The deals that we signed 3 quarters back, that would have already, some of it would be already in our run rate in this quarter. This quarter we did 3.3 quarter on quarter, and after a 5.6% in the previous quarter. So some of that is in the run rate, and it will continue to accelerate. So if there are no questions, sorry.
Hi, Leroy from Cogensis. So you've given a guidance of 7 to 9% for organic growth and about 7% for revenue from IBM acquisition. That does not leave a lot of room for any other inorganic growth. So are you going to make any acquisitions? Like you've said that you'll be looking at acquisitions for capabilities, but is there anything happening?
Yeah. Pratik can take it.
So, Leroy, what we have factored in is deals which have already closed, which includes the deal which closed on 1st of April. So that is all factored in. Whatever happens later is for later.
So you'll be revising it later depending on whether
Exactly.
you make any acquisitions.
Exactly. So this factors in all that has happened
So
till
far.
date.
So if there are no questions here, we are happy to take questions from the participants on the call. Over to you, operator.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Participants on the audio bridge, if you'd like to ask a question, you may please press star and 1 on your touchtone telephone. Participants are requested to use handsets while asking a question. Anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Ranjit Shinde from Economic Times. Please go ahead.
Hello, sir. Thank you for taking my question. First question is about the operating margin guidance, which seems to be around 100 basis points lower. So while your revenue guidance is quite strong, so what's happening? Is it like there is some pressure on your realization or something, or investments are going up? That is first question. Second question is about the velocity of your dollar profit. While revenue is growing faster, but it seems like the dollar profit growth is kind of lower, 4.6%, if I'm talking about FY'19. And FY'18 was 77.8%. So what's happening on these two fronts?
Yeah, first, let me, yeah, go ahead. You go ahead.
So Ranjit, first of all, on your margin guidance question, see, we closed the last year at 19.5% for the full year, but the last quarter of the year, which is also representative of the exchange rates going forward, etc., was at 18.9. So there was a lot of volatility during the year, as you know, but the exit run rate that we have is 18.9. So considering all of those factors and our plans going forward, we have given a range of 18.5 to 19.5, including all of those factors.
Okay.
Your second question was around the dollar growth rate versus constant currency. Now, that tends to be a factor of, tens of different currencies. Most prominently, of course, the European GBP and Euro, and of course, Swedish kroner and so many others. So, typically the way we look at it is constant currency is the best barometer to keep measuring all things on an even keel. The dollar can appreciate or depreciate against other currencies, and our report comes out in dollars because that's the most common currency around the world. That came in at 10.1. I'm not sure where you are picking up the 4% type of number
So
that you said.
That was profit. I'm talking about net profit. So the net profit growth was 4.6% for FY'19, and this is like, it seems it's like 3-year low. So FY'18 was 7.8, and FY'17 was 12.9. So now it is 4.6. So I'm just wondering what's happening. I mean, are we losing some kind of grip on profit and profitability while improving our top line, or what's happening?
No, so I don't know where you are picking up, but if you see page 14, the last column, it shows the 10.1% that I talked about on the top line. And in EBIT terms, it is 8.8%, which is very much in line. And on net income, it is 5.9. It's not 4 point something that you're talking about. The point remains that in the last year, we had some extra gain on foreign exchange, which you can see in the numbers. But otherwise, it's, if you look at EBIT, which is really the operating profit, as they call it, that has grown close to 9%, which is in line with the 10% top line growth.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Shriram R. from Mint. Please go ahead.
Hi, good evening. Just two questions. One, how do you characterize the business environment? FY'19, we have had a very good year in terms of large deals like Xerox and Nokia contracts.
Srinam, we are not able to hear you very well.
Hello?
Yeah, go ahead.
Hello?
Go ahead.
Yes, sir. Is it better now? Can you hear me?
Yeah.
Yes, it's better. Thank you.
Yeah. Just trying to understand, sir, I want to get your view on how will you characterize the business environment. FY'19, the company has had a very good year in terms of large deals, such as Xerox and Nokia contracts, which are quite large. Do you foresee any such kind of momentum continuing in the coming year? That's my first question.
Yeah, I think overall, I know FY'19 was a good year. We expect FY'20 to be also a good year. If I look at the pipeline that we have, what I had at the end of December and what we have now, there is a 10% growth. So our pipeline, in spite of our good booking, the total pipeline continues to increase. So I would expect a good performance from a demand environment perspective and our ability to harness the demand.
Okay, and my second question is on the Mode 2 and Mode 3 businesses. Obviously, the company is investing heavily in these segments, but when do you see these segments contributing positively to the operating profit margin in terms of profitability? Or how should one look at the possibility of that happening?
See, I think the overall opportunity on digital transformation is tremendous. So we are calibrating, and as we see more and more opportunities, we are continuing to invest and make sure we continue to build capabilities, which is not just localized to a few geographies, but in all geographies that we are operating in. So we've considered all that. What is the opportunity ahead of us? What is the investment that is needed? And that's been baked into our 18.5 and 19.5% operating margin guidance. And we do believe this is the time to continue to look at investing into building your next generation services capability, because there's lots of things which are happening in the technology space, and one needs to really be very, very eager to do all the right things so that the long-term momentum that we want to build in the business is intact.
Okay, thank you, sir. Thank you very much.
Thank you. I think we've run out of time, operator, so I can take at best one more question. Otherwise, we can close the call.
So there are no further questions on the audio bridge. You may go ahead with the closing comments.
Sure, thank you. Thank you for joining us today. We've had a fantastic year in terms of our overall performance on all fronts, and we have a very good future to look forward to. And thank you for your support, and look forward to seeing you in the next quarter. Thank you.
Thank you.